Bollinger Band squeeze is a great chart pattern that enables you to locate strong and profitable trade setups. When the market becomes too slow and there is a low volatility, the price moves sideways and the Bollinger upper and lower bands become very close to each other. This is called Bollinger Band squeeze. You can see it on all time frames very frequently, especially on the shorter ones. Sometimes Bollinger Band squeeze is continued by many candlesticks, and sometimes it is only for a few candles. It really doesn't matter how many candlesticks are inside the squeezed Bollinger Bands. Something that matters is that such a market is not going to remain calm and quiet forever, and this low volatility will be followed by a strong movement. This strong movement can be profitable for traders if they enter on time. Bollinger Bands squeeze trade setups are really great because the movement that happens after the squeeze is usually too strong, and above all, we can enter with a very tight stop loss and a wide target. Bollinger Band squeeze are really profitable and have a great risk to reward ratio because they show us the beginning of a strong movement and hopefully strong and continued trends. So Bollinger Band squeeze occurs when the volatility falls to low levels and the Bollinger Bands narrow. According to John Bollinger, periods of low volatility are often followed by periods of high volatility. Therefore, a volatility contraction or narrowing of the bands can foreshadow a significant advance or decline. Once the squeeze play is on, a band breakout signals the start of a new move. A new advance starts with a squeeze and a break above the upper band, while a new decline starts with a squeeze and a break below the lower band. Before diving into the details of this strategy, let's briefly review some of the key indicators. In this example, we are using the daily prices and setting the bands at 20 periods with 2 standard deviations, which are the default settings. These of course can be changed to suit your trading preferences or the characteristics of the underlying stock or currency pair you are trading. So Bollinger Bands start with a 20-day SMA of the closing prices. The upper and lower bands are then set at 2 standard deviations above and below this moving average. The bands move away from the moving average when the volatility expands and move towards the moving average when the volatility contracts. There is also an indicator for measuring the distance between the Bollinger Bands, and this indicator is called Bollinger Bandwidth, or just the bandwidth indicator. It is simply the value of the upper band minus the value of the lower band. Understandably, stocks with higher prices tend to have higher bandwidth readings than stocks with lower prices. Keep in mind this detail when using the indicator. The Bollinger Band squeeze is a straightforward strategy that is relatively simple to implement. First, look for stocks or currency pairs with narrowing Bollinger Bands and low bandwidth levels. Ideally, the bandwidth should be near the low end of its range. Second, wait for a band break to signal the start of a new move. An upside breakout is considered bullish, while a downside band breakout is bearish. Note that narrowing bands don't provide any directional clues. They simply show that volatility is contracting and that you should be prepared for a volatility expansion, which means a directional move. So you need Bollinger Bands narrow on the price chart. The bandwidth must be near the low end of its range, and the price breaks above the upper band or below the lower band. Even though the Bollinger Band squeeze is straightforward, this method used by itself, without context, will not bring consistent gains. That's why you should combine this strategy with basic chart analysis to confirm signals. For example, a break above resistance can be used to confirm a break above the upper band. Similarly, a break below support can be used to confirm a break below the lower band. Unconfirmed band breaks are subject to failure. So let's take an example to make it very clear. This chart shows the AMD on the daily time frame with several signals within a week period. After a surge in price, the stock consolidated with an extended range. AMD broke the lower band several times, but didn't break the key support level here. Basic chart analysis reveals a possible flag type pattern, and although this might look at a first glance as a Bollinger Band squeeze setup, the support right below the breakout invalidated the trade. At the same time, the market was making higher highs and higher lows. So why would you take a Bollinger Band squeeze trade against the trend? Notice that this Bollinger Band squeeze pattern formed a few days later, which makes it a bullish continuation pattern. AMD price broke above the upper band, then broke resistance for confirmation. Here are other examples of valid Bollinger Band squeeze trades, taking into account support and resistance levels. Because the Bollinger Band squeeze doesn't provide any directional clues, you must use other aspects of technical analysis to anticipate or confirm a directional break. In addition to basic chart analysis, you can also apply complementary tools to look for signs of buying or selling pressure within the consolidation. Momentum oscillators or moving averages will have no use during a consolidation because these indicators simply flatten along with price action. Instead, you should consider using volume-based indicators, such as the money flow index or the on-balance volume. Signs of accumulation increase the chances of an upside breakout, while signs of distribution increase the chances of a downside breakout. This chart shows Micron technology with the Bollinger Bands squeeze occurring here. The bands moved to their narrowest range in months as volatility contracted. The indicator window shows money flow index weakening and below its 50 level. Notice that the money flow stayed below its 50 center line and continued lower as we had the Bollinger Bands breakout. Money flow readings below 50 reflect distribution or selling pressure that can be used to anticipate or confirm a support break in the stock. Also, notice the second Bollinger Band squeeze here and the imminent breakout. During the squeeze, notice how the money flow stayed above its 50 level, which showed accumulation during the trading range. Signs of buying pressure or accumulation increased the chances of an upside breakout. As the price closed outside the upper Bollinger Bands, we also had the money flow increasing even higher, confirming the move. This is how you increase your chances of finding valid Bollinger Band squeeze breakouts. Pay attention to the volume. Here are other examples of Bollinger Band squeeze trades confirmed by the volume. In his book, John Bollinger advises traders to beware of the head fake. This occurs when prices break a band, then suddenly reverse and move the other way, similar to a bull or bear trap. A bullish head fake starts when the Bollinger Bands contract and prices break above the upper band. This bullish signal doesn't last long because prices quickly move back below the upper band and proceed to break the lower band. A bearish head fake starts when Bollinger Bands contract and prices break below the lower band. This bearish signal doesn't last long also because prices quickly move back above the lower Bollinger Bands and proceed to break the upper band. The key here is simple price action and paying attention to swing highs and lows. An uptrend can simply be defined as a series of higher highs in price coupled with higher lows. In other words, the overall price direction is higher, even though the prices will experience corrections along the way. A downtrend is a series of lower highs and lower low price swings. This may seem like elementary principles, but in their simplicity is their elegance and usefulness. By understanding these simple concepts of trends, it is possible to determine when a trend is healthy and when it's about to reverse. exploit a higher low in an uptrend and a lower high in a downtrend to capitalize on a changing market direction. That's why, when I see a breakout after a Bollinger Band squeeze pattern, I'm always aware of the recent swings. If the market makes higher high in prices, I search for bullish breakouts. If the market makes lower highs, I search for bearish breakouts. This way, I avoid the head fake pattern. Use this simple filter and you won't be trapped in the head fake pattern. Now, Bollinger Band squeeze is a trading strategy designed to find consolidation with decreasing volatility. In its purest form, this strategy is neutral and the breakout can be up or down. That's why you must employ other aspects of technical analysis to formulate a trading bias, to act before the breakout or confirm the breakout. And remember that trading with a less established trend also increases your winning odds. If you learned something new and found value, leave us a like to show your support and don't forget to subscribe and hit the bell icon to stay in touch with new uploads. Until next time.